And welcome into the NIL Lounge. I'm your host, Andrew Miner of the NIL Report. And today's guest, we have Kyle Dunham, who is a certified financial planner or CFP with Raymond James up in Dallas. Kyle, thanks so much for coming on and joining us today. How are you?
I'm great, man. Thanks so much for having me. I'm really excited about it.
Yeah, I'm excited too. And obviously, our goal of today's conversation is really to just give some foundational building block advice for student athletes and really any young person, I think. But student athletes specifically is what we're tailing the conversation to. That, hey, once you can now make money, once you have some money in the bank and you've taken care of your expenses and things like that, what do you do with it? You stuff it under their mattress, you just put in all of the cash in your wallet, do you use a bank account, other investments, Bitcoin, there's so many options out there. And I think, having someone that is a licensed professional to, lend their industry expertise like yourself is fantastic. And of course, everybody watching out there, please, this is not financial advice custom to you who might be watching. So please make sure you do your own diligence and do your own research. But Kyle, if you could, just feel free to introduce yourself and tell us a little bit about what you do.
Thanks, Andrew. Yeah, my name is Kyle Dunham. I work with Raymond James. I work on a team with two other advisors, and I've been in the business for going on 8 years now. And what I started with was being in the call center. I came from Baylor with philosophy and religion degrees, so that's a little unique coming into this industry, but it's really enabled me to come in with a fresh perspective. So yeah, I started in the call center and talked to a lot of young people, old people, people who have money, people who don't. And I've got a book of a lot of clients now. So I've seen a lot of situations, and I'm really excited to be able to share that experience with you guys.
Yeah, that's great. And obviously you're a certified financial planner, you're a CFP. So I think that's a little bit different than just a generic broker. Can you explain kind of what goes into that, the licenses that and the exams that you have to take to become a certified financial planner, and what the difference is between that and just a generic broker, maybe?
Yeah, great question. So being a certified financial planner, this is getting a little bit in the weeds, but there's a lot of differences and laws that have come out and changed in the last few years. What the certified financial planner does is it holds me to a higher standard. So my education on all facets of the industry, tax planning, estate planning, um, retirement plans, all kinds of things, is at a higher level. And so by being a member of the CFP group, I'm also held to the fiduciary standard whenever I am giving advice. So that means that it's got to be in my client's best interest as opposed to other brokers who may have the ability to just go based on what's suitable. So whatever fits for your general profile, they can recommend. Whereas for me, it has to be in your best interest, the best thing for you out of all the options, regardless of what that means for me as the person selling it to you.
Yeah, I think you hit the nail on the head, right? It's that fiduciary responsibility that a CFP has that other brokers or anybody else that's dealing with money management does not have. So when you're talking and reaching out, the audience, I'm talking to the audience, when you're reaching out and talking with people that want to invest your money or help you with money, always make sure to ask that question. Are you a certified financial planner? Are you a CFP? Do you have a fiduciary responsibility to me? Or not, are you legally obligated? So, yeah, that's really important. And we don't have to get in the weeds, but it's rigorous training, rigorous exam work that one has to undergo and undertake to get that certification.
Certainly.
Kyle, you mentioned very interesting background, philosophy and religion, going into the financial space, and now you've been in there for nearly a decade and have experienced, every experience I'm sure is different. Every situation is different. What are some of the top takeaways and would you say that you've had, in over the course of your career?
Yeah, thanks for asking. That's a really good question. So coming in with my background, I knew almost nothing about money, and I had all these ideas of, I'm going to get investing in the stock market and find the next Amazon and instantly become a bajillionaire, right? I think that's the dream when most people talk about investing. Um, And I've found that, to get that to happen, you have to be either incredibly lucky, which it does happen. So I'm not going to tell you that it doesn't, or the smartest person in the world. I am not the smartest person in the world. So what I've decided to do with my own personal investing, and what I would recommend for the majority of people who don't want this to be their full-time job, is taking advantage of products that have a broader diversification. So the way that you make that happen, where you go from 1 to 1 million, and this may not be your question, Andrew, is you are all in on one thing. But when you're all in on one thing, that might go down as well. So you might lose your investment. So one of the things that I've learned coming into the industry that I didn't expect was that spreading out your bets, so to speak, has such a drastic impact on what you do on a day-to-day basis.
Yeah. Can you talk a little bit more about that diversification? So I think a lot of people might see, the stock market, like you said, putting it all in Amazon or one stock, like it could go up to a million, or it could go down to zero, and they kind of see that as gambling. You said spreading your bets across, but again, it's not really, gambling per se. I think that gets the bad, a wrong, a bad reputation. But can you talk a little bit more about diversification in what you do and like within, portfolios?
Yeah, absolutely. So in what I do, there's lots of ways to look at stocks, companies, even countries. There's different ways to invest. So as I think everyone's aware, there's stocks, there's bonds, which is basically debt. You own the debt of a specific company and they pay you interest payments. Then at the end of the term, you get all your money back. So bonds are boring, but they're very safe. Stocks are more exciting, but they're less safe. And then there's lots of different words and packages surrounding that, those two things primarily. They've been around, stocks and bonds have been around for 100 years. They are not new. There are other new things like Bitcoin, investing in all kinds of unique items like coins, collectibles, etc., that are other ways that we would classify as investing. But those are not things that I specialize in. So I'm just going to talk about what I specialize in, which is primarily stocks and bonds.
That's fair.
The expertise that I have is really with managing the managers of those stocks and bonds. I can, and I'm licensed and qualified to run my own money, is what it's called. But I think, and my advice to almost all of my clients is to use someone whose only job is to look at the markets and position the portfolio appropriately, because things change on a day-to-day, moment-by-moment basis, particularly in the stock market where there's moment-to-moment pricing changes. So what I would recommend is to trust someone whose whole job it is to invest that money for you and pick the right stocks and pick the diversification, especially for young people who are dealing with school and, in this case, sports, and have all these other commitments that take up so much time. I've not seen someone who has the capacity to sleep, work, go to school, practice, all those things, and manage their money appropriately. So I would recommend looking into what are called mutual funds, which are managed what's called actively, where someone's picking things individually, or ETFs, where it's a computer program picking it for you individually. Mutual funds are a little bit more expensive, but it's a real person at the controls. It's a real group of people at the controls who are deciding what to invest in, what not to invest in. And an ETF is, generally speaking, a real person putting into a computer these dynamics, these parts of a company that they want to have in their fund, and then the computer trading to that throughout the course of time.
Yeah, I think that makes sense. And these mutual funds and ETFs they consist of many different stocks within them.
Yes.
So basically, if you invest in one of those, it might have Amazon, Facebook, Home Depot, a bunch of different, hundreds of different stocks. So even if Amazon ticks down a little bit, maybe Home Depot, ticks up a little bit, and then, vice versa. Over time, the expectation is that the market is hopefully going to generate a 6, 8, 10% return for your portfolio.
Yeah, that's a really good point, Andrew. I actually have a slide. I promise I'm not going to kill you guys with slides today, but I do have one that I want to show you guys. Do you mind if I share the screen?
Please.
All right. So this chart is, can you see it, Andrew?
Yes.
Okay. This chart is an explanation of the blue bar being the average investor return for these various time periods, and the orange bar is what the S&P 500 has done. The S&P 500 is what's called a benchmark, which is a collection of about 500 stocks in the US, and it has been a good barometer for years as to investing in the US economy as a whole. It's the almost 500 biggest individual stocks in this US, in this country. So you'll notice across all time periods, 1 year all the way to 30 years, the blue bar is lower and sometimes significantly lower than the orange bar. What's the deal with that? Why does an individual investor generally do worse than just leaving the money in 500 companies? The answer to that is really easy and simple to talk about, but once you get into the details, it gets really complicated. So I'll just stay at a high level. It comes down to basically timing, being that you might put your money in at the wrong time and especially take it out at the wrong time. And then the other being behavioral finance. So this is a growing field of research that is basically, why are people with their money not rational? And it and how are they not rational? Because the answer is obvious. You're not rational when you're afraid of losing your money, when you're really excited about this potential opportunity. You make irrational decisions, which can cost you money and has cost investors money over all these time periods. So that's the first chart that I wanted to share. And you can see that essentially the best way to grow your money, and what I think I've seen the smartest investors do, is allocate a certain amount of each paycheck or each NIL check that you get, if not the whole thing, and you put it away and you invest it according to your goals, and then you don't touch it. You let it roll. When the market goes up, you're excited, but you don't brag about it. And then when the market is down, you don't brag about it. You don't worry about it. You don't take it out and say, well, I'm going to be safe right now. Because what the math shows us and what this chart shows us is that if you just leave it in this general benchmark, then you're going to outperform over the long time.
Yeah, I think that's really smart. So look, we may have skipped a step here, and that might be my fault for the line of questioning. I get really excited about this, and I tend to jump in. But if I'm new, fresh in college, student athlete, and I'm looking at it, a lot of these athletes and young people in general are looking at markets, investment, managing money for the first time. What are like a few pillars, if you will, of just potential things that they could do with their money that you kind of see on a daily basis? Like, kind of what are the options out there for them? Obviously, I think most people know, like, okay, I'm going to set up a banking account, a savings and checking. But maybe not a lot of people even know what you just explained with, the S&P 500 and mutual funds. Obviously, there's, things that make it seem like gambling, exciting options that are always come around, like different stocks on the Robinhood trading app, or like Bitcoin, crypto, NFT trading cards, which I think a lot of athletes are, have been into, which is great, that monetize their name, image, and likeness that way. What are just what categories would you say, like, hey, here's, the 4 or 5, whatever it is, main avenues that you've seen as investments for money, and ways to store, invest, hold your money in your portfolio? Because obviously it's going to be diverse.
Yeah, that's a great question, and it should be diverse. So the way that I have learned and developed to manage finances is really, what is the goal of money at a high level? The goal of money is to spend the money and use the money to enhance your life, to on a basic level provide for your needs, and then hopefully you make enough money to where you can provide for all your wants and what you wish to happen as well. So those things are diverse and can be very different. So you need to allocate your money that you make to those goals. So if you need your money to put a roof over your head, if you need your money to make your car payment or what have you, you should use your money for that. And in that case, a bank account, a checking or savings account would be the best. For you guys who may not have to struggle with that, and who have, let's say, a $10,000 name, image, and likeness check, you can invest that for your long-term goals, especially if you go pro or work as a business owner or just not in a company. Your saving for your later in life retirement is on you. The government, the Social Security industry, department, whatever you want to call it, they are not going to account for as much of your living situation as you might think. So what you need to do is save for the long term for growth. And there's a few ways to do that. As Andrew said, there's NFTs, there's Bitcoin, there's you can trade in currencies if you really want to get fancy. And then there's a general brokerage or investment account. You can get these through financial advisors like me at my company, Raymond James, or you can go through a Charles Schwab, TD Ameritrade, Robinhood, and you have access to almost all the same stuff. There are some other really cool investments that I think are beyond kind of the scope of what we're talking about today that we have access to, called alternative or private alternative investments. Those are things like hedge funds, private equity, et cetera. And when you guys strike it rich, then we can talk about that for sure, because that's really exciting stuff. But generally speaking, there's really those three avenues. And I think it's bank account, investment account, and then Bitcoin, NFT, buying individual gold bars. Those are all kind of a third category that I generally do not recommend for people. If that's the only thing you do and that's your whole job is to do Bitcoin, NFTs, etc., I've heard of people being really successful, but I've also heard of people really losing a lot of money that they couldn't afford to lose on that. So that's a higher level of risk of losing in that area, and I generally don't recommend that, particularly not for people who have so much on their plate already. So those are kind of the three avenues, if that answers your question, Andrew.
Yeah, it does. So I think if you're an athlete, with NIL money coming in, I think you have to kind of map out. It sounds like what you're saying. Correct me if I'm wrong, Kyle, but map out kind of what your monthly expenses are, what you're spending money on. Track that so that when you have money coming in, whether it's a stipend that the school is giving you, whether it's a brand deal that you got for posting online, how much to set aside and allocate to put in your checking and savings accounts, so that what you have after your spending, and then whatever's left over, and earmark some money, put away some money for taxes, right? Especially if you're making large sums of money with NIL. But once you do all of that, and whatever is left over, so say it's 10,000 left over after you account for your rent, car, food, etc., taxes, then put a portion of that 10,000 maybe in some checking savings account where it's federally insured, it's backed, there's no risk of losing the money, usually up to $250,000, and then take another percentage. That's kind of your rainy day fund, right? And then take another percentage, maybe a larger percentage, especially if you can afford it, and kind of plan for the future and kind of think long term in decades, really zoom out and say, hey, if I put a couple $1,000s or even a couple $100 a month into some S&P 500 or mutual funds, then I can expect that to compound over time and grow. And it's not 100% risk-free, but it is backed by a lot of historical data and evidence that it's going to grow and compound over time. And then finally, you have your alternatives. So if you wanted to dabble in, anything else that's out there, NFTs, crypto, individual stocks, gold, silver, commodities, right? That's definitely up for the taking, but just know that, again, the data shows that the individual investor probably is not going to do well historically on just throwing money into different investments like that. I thought
Yeah.
I don't know if you watched this on Netflix, the recent documentary on GameStop, and everybody trading that stock on Robinhood was very fascinating to me. I did watch that, but
Yeah.
some people were really, really successful, and some people lost a lot of money, doing trades on that way. So
Yeah.
uh,
That's one of the things. So first off, I think you're exactly right on your earlier comments in that one of the things that we really work on with our young clients is that budgeting aspect. So based on whatever your situation is, let's say you're an NIL athlete who makes $10,000 a year in brand deals. Uh, you got to save some of that for taxes. So keep that in a bank account, being very safe. You got to pay whatever bills you have on top of what's provided with your dorm and what have you. And then the rest of that, we can talk about how to waterfall it. So I'm a very visual person. I think of it as buckets. You have your top bucket as what you need every month. And then the money comes in, the $10,000 check comes into this bucket. And then once it's all filled up, it overflows and goes down into the next bucket. And that next bucket would be things that you may want in the next 1 to 5 years. And that's, you want to buy a car, you want to have a down payment for a house. You can take a little more risk of volatility with that money because you have time to make it up if there's a loss, essentially. As we've seen with the stock and bond market, they have what's called a positive bias, meaning they go up, they go down on a daily basis, but it's kind of like a yo-yo on an elevator. They go up and down day to day, but the elevator is going this way. So even though it might go down next year, you're still going to have more money than you started with. So that's one thing that we work on a lot. And then obviously the waterfall continues to flow over. Once you have that goal set for your next car, your home, your next biggest goal that you need to start saving for. And we see this with athletes all the time. I don't personally, but I have other colleagues who have worked, and their whole practice has been built around professional athletes. And it's shocking how many of those guys have to get another job after they finish with these multi-million-dollar contracts because they just didn't save enough for their future. So it's not uncommon to see someone who played in the league for, I don't know, 5, 10 years, who made $1 million every year, who has to go work in some other industry and start from scratch at 35. That's not what I think any of us want to do, and that's not what we have to do if we can plan on the front end for these things.
Yeah, I think that's an excellent point. And I don't think the message or the takeaway should be, okay, they're just telling me not just to throw money in a brokerage account and let it grow, which definitely should, but no, plan to try to satisfy some of your wants and your dreams and things like that too. We all know things cost money, and that you're going to need to want to go on a big trip, or travel overseas, or start a business for yourself. All those things cost money, and the last thing you want to do is put all your NIL money right now into an investment account and then withdraw it sooner than you have to, and not let the power of time and compound interest really do the work for you. So it's again goes back to knowing, I think, your personality, your financial comfortability with doing these things, and planning for that. And like you said, Kyle, like meeting what are your goals, and what do you want to achieve in the first 1 to 5 years, and then what are your long-term goals. And I think investing, starting early, even if it's just a couple $100s a month that you're putting in an account, has really shown, again, historically speaking, that it will compound. And my belief is that if you're a college athlete and you have the ability to make money, and a lot of NIL collectives and other brands and partners are literally throwing money at some of these athletes in school-wide deals and everything like that. I would try to take that and let time do the work for you for some of it, and hopefully you'll be in a really positive position after you graduate and beyond. And I think for that reason, I think every athlete has an opportunity to have a net worth of $1 million much sooner than I think anybody could possibly dream. So
right, and that's the second time at least that we've talked about the power of compounding in general. And my second and final chart is actually on this topic, so I'm going to share my screen again and kind of explain. This is a little bit of a complicated chart, but I'll explain what you're looking at here. Can you see it now, Andrew?
I can.
Okay, great. So what you're seeing is the account growth of $10,000 invested annually. The blue line, the person who ends up with almost $2 million, invests starting at 25, and she contributes a total of $400,000. Now she's only earning 6.5%. That's an important number because that is a conservative estimate for what a stock portfolio could get you. As we saw on the last slide, if you just look at the S&P 500 over the last 10, 20, 30 years, let's actually go look at that. So 10 years, you're looking at a return of about 7.5. 30 years, you're looking at about a 10% return. So this 6.5 is completely achievable with just kind of a general investing strategy. So she puts in $10,000 a year for 40 years. It grows to $2 million. That's more than 4 times what she put in. Right? Yeah,
Yep.
4 times.
Yeah, yep.
By a good amount. I don't know why I doubted myself on 4 times 4, but
you got it.
This next person, Quincy, he only invests from 25 to 35. He invests $100,000. He still ends up with almost $1 million at 6.5%. Like, this just shows, even if you only contribute for 10 years to an investment vehicle, what it can happen, what it can turn into. This is no one specific account. This is just general math. You're not going to return 6.5% every year in any investment. Investments go up, they go down. One year you'll return 40%, one year you'll return negative 30%. But generally speaking, on an average return basis, just investing for 10 years, earning 6.5% for the rest of the time until you're age 65, you end up with almost $1 million. So young people, particularly athletes still in college earning money, have such an advantage because they can start at 19, and what this chart does not do a great job showing is what's called the rule of 72, which is if you're getting 8% a year, your money doubles every 9 years. So you change this 6.5% to 8%, that's a totally different number based on the compound growth. You start this at 19 versus 25, that's a totally different number. That's probably almost another $200,000 based on the math in my head of what that could turn into. So this is showing that the earlier you start and the more consistently you can add money to it, the better you'll be set up for in the future.
Yeah, I think this is a great chart. Thank you for this visual, Kyle. And every situation is going to be different again. So you really have to, just do some homework for yourself on the front end. Talk to some, CFPs, some professionals, if you'd like, and get advice custom to you. But some, starting young is really good. And some athletes might only have the 4 years in college to make money. They're not going to go professional, or they are going professional, or obviously going professional is great and can continue to just, contribute way more than what you showed on the chart. But then, you don't know what life would hold. My point is, you might not know what life will hold. So you say you're investing from 19 to 29, 10 years, and then you stop, and you might ask, well, why would I ever stop? Well, you might might have something else come up, or you might want to start a business, and or find a different investment that is better, more hands-on for you, and you need cash flow, cash on hand there, and that's why maybe you stop contributing. But putting some money aside and getting an account, it's going to continue to grow, and hopefully those habits instilled now will help you plan for that and continue to invest, even in the future. But there's lots of different scenarios. Kyle, real quick, before we wrap up, just real quick, what's your favorite, kind of money story that you've had, without, disclosing any information? It doesn't have to, it could be yourself, or something you've read, or what have you. But I'm just curious, like, what's the most unique story that you've seen that kind of really opened your eyes?
Well, this is maybe not an answer to your exact question, but my favorite money story is one that is not unique. It is the person who starts saving when they can. Not everyone can save as soon as they get out of college, or save during college. The person who starts saving, who contributes to their 401k, who over the course of years they raise a family, or they move states, or they move careers 2 or 3 times, and they are able to build a life for themselves, totally securely, based on those buckets we talked about earlier, those waterfalls. Their base needs are all met. They're accomplishing their goals by saving in these medium-term accounts. Like, they buy a boat, and that's a huge achievement for them. They buy a second house, and that's a huge achievement for them. Those are my favorite stories, are the people who consistently go at it every day, who let their money compound, and then they retire when they want to, not because they have to at any given age. They can stop working at 60 because they've started saving at 30, and they have $2 million or more in some cases. And some of my clients' cases, they got more promotions than they expected, or their own business took off more than they expected, and they've got 7, 8 figures to work with, and they can do what they want with their time. That's what's most fulfilling to me. I think what we didn't talk about at the beginning is, I got into this business because I want people to do what they want to do on a really core basis, and I want to help people get there. So what's most meaningful to me are those people that I can help make their dreams come true. To be super cheesy about it, I want to help you figure out where you want to be in 5, 10, 15, 30 years, 60 years in some cases, and then help you get there. So I love when those stories work out. And one of the things that prevents that from happening, to be kind of a little bit of a negative Nelly, is people who get so hyper focused on it that that's what they think about in their free time. This is a bolt on to your life. This is meant to enhance your life. It's not meant to be your life. Money should not be the tail that wags the dog. You should live your life, and then let the money enable you to do that. So those are my favorite stories.
Yeah, to become financially free, so that you don't have to. I've played basketball with many players at Baylor during my time, and to see that they still have to go into a job, and in a professional setting, and not have the freedom that they maybe could have had if they were able to generate some income for themselves and invest it, and do whatever they want afterwards. And that doesn't mean just not work, but it means you kind of get to pick what you work on, which is really cool. And that's should be the end goal, I think, for a lot of athletes today. Kyle, thank you so much for joining and lending your time and expertise. Really appreciate it. And how can people contact you if they so choose, so want to? Is there a good email? Or
thanks for that. My email is Kyle, KYLE .Dunham, D as in dog, UN as in November, HAM as in Mary, at RaymondJames.com. You can send me an email anytime. I'll try to respond to you within 24 hours. But on Labor Day weekend, it won't be 24 hours. I'll tell you that much.
Great thing. Well, thanks so much, Kyle. I appreciate it.
Thanks a lot, Andrew.